Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab. And this is Long Verticals and Diagonals. And today I'm going to be talking about a weekly vertical spread strategy where a trader is planning to get in and out in less than 5 days. In and out by Friday. That's what we're going to be talking about today. A lot to cover in that discussion, weighing the pros and the cons, when a trader might take those positions, when they might exit. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see so many familiar names, as always. Hello there, Rick and David, Life in the Fast Lane, Scott, Sharon, Gang Dahar, Jack, Josh, everybody else. Thanks for joining us week after week. I really appreciate your attendance, your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation. But be aware that you're invited to join us in the live discussion. This is a Thursday webcast series. It kicks off promptly 11 Eastern time. We would love to have you here in our live audience. I also want to let everybody know who's here live that we have Brent Morris hanging out in the chats with us. Brent's going to be addressing any questions that I can't get to just during the flow of the presentation. Brent and I have been working together for more than 20 years. So I've been at this for a long time. Brent's been at it for years longer. So a great resource to have. Thanks for having my back there, Brent. And Brent and I would like to issue an invitation to everybody watching. If you have an account with X, give us a follow on X. You should be following your favorite presenters there. It's the very best place to connect with us in between these live streams. You can find Brent there at Brent Morris CS. You can find me and follow me on X at Cameron May CS. But let's get into this discussion. And certainly risks are associated with this strategy as with others. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research. Investing involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set an agenda for the day for what we're going to be covering in this webcast, in this video. First, we're going to take a quick look at existing positions. There's one I think that needs some attention. There's one that's already been concluded while class was not in session. So we'll revisit those. And then we're going to take also a quick peek at the S&P 500, see what's happening today. Let that be the backdrop for planning and placing a new trade. Today's trade is explicitly going to be a long call vertical spread where the trader is planning to get in and out within 5 days. So in and out by Friday. In this case, since this is a Thursday webcast series, it'll be in and out by next Friday. But we're going to be weighing the pros and the cons of that sort of approach. What might a trader look for in a stock as a candidate? How might they select the strikes? How might they manage the back end risk? All of that, a lot to cover. So let's get right to Thinkorswim. This is the Thinkorswim desktop trading software platform. If you don't have access to it right now, it can be downloaded free of charge from within your Schwab Online account. Just go to the trade tab and you'll see and look for Thinkorswim. You'll be able to download from right there. But here are our current positions. But we need to talk about last week's trade because we got into it during the webcast last week. We attached exits to it. One of those exits was triggered. Our stop order was triggered. So here was our Visa trade from last week. Bought a 340 long call, sold a 345 short call. The stock was up here in a channel in what had been a nice bullish trend. And we got into this on the assumption that maybe price would continue to rise. Well, guess what? It didn't. It fell. We broke down through that support, fell down, triggered our stop. Here's what that looks like. If we go to our monitor tab and the account statement, we look back over the last 8 days, we can see here was that Visa entry. We opened here for a 375 debit, and we dropped and sold out for a 196 credit. So that's a realized loss of $1.79. That happens sometimes. Sometimes, despite a trader's best efforts and despite their outlook for a stock, the stock has a mind of its own. In this case, it dropped, and we have stemmed the bleeding on that. And we'll see if that turns out to be the right decision. But as of right now, it looks like the stock is continuing to sell. So maybe we minimize that damage. But that's it for that position. These others with AVGO, GILD, Google, and NVIDIA, I don't think we're going to be making any changes. Just so you can see what those are, though. With AVGO, we have a 270, 280 long call vertical spread, where we'd have a preference for the stock to be above 280, and right now it's at 303. So that one's doing great. GILD, we own some long calls as part of a diagonal spread. We've closed out the short position. Let's look at GILD on our chart here so we can revisit the history here. Bought those long calls all the way back here, and the stock has generally worked its way higher. Along that way, we've sold some short calls against that long, collected a number of profits. There were a couple of losses back here, but our stock is pulling back right now. That's not helping out that long call, but we're still holding on to that. But there's an earnings announcement. We're not going to be placing a short call over that earnings. That was our plan. No short call before earnings. So we'll look at this again next week. Nothing to be done with that one today. Looking at our Google position, this is another long call diagonal spread. Bought the 180, sold the 205. With this, we'd prefer for the stock to go up, stay solidly above 180, but stay below 205 as we move toward that 15th of August expiration. And it's pretty much doing that. We're at 196 right now. So if we look at that on a chart, own the long call down here, we entered both of these positions right there. And net, we've moved higher, which has been great for the long call, but we're staying below the short. So that's great too. We'll let that continue to work. NVIDIA, yet another long call diagonal spread. We own the 145 for the 20th of February, sold the 180. The preference here is for the stock to go up, helping our long, but to stay below the short strike of 180. Look where we are right now. We're at 182 with 8 days left on that short call. I'm not going to be making any changes to this. So this is the NVIDIA position, but I have the luxury of not making any changes due to the fact that this is a paper money account. There's no risk of early assignment. There certainly could be a risk of early assignment if this were a real trade, particularly when an option goes in the money like this one has. Now, right now, it looks like we have a bit of a shooting star pattern here, where we have a small body on a candle with a long wick sticking out the top. It means that the stock rallied intraday, and now it's really fading. So maybe we can get this back down below 180. We'll look at this again next week because we have that luxury. I know for sure it's not going to be assigned. That is not real life. So RTR says, when would you close? So a trader might consider doing, if they're really concerned about early assignment, particularly as we get in the money closer to expiration, a trader might think, I might need to buy this back. Would we be doing that at a loss right now? A kind of a modest loss. We sold this for 405. We might be able to buy it back for somewhere around 470-ish. But you can see our long call is doing great. So losing 65 cents on the short when we're sitting on an unrealized gain of about $16 on the long, that's okay. But yeah, if that early assignment is a concern, and it is a consideration in any case, that's when the trader might really start to pay attention to this. I'm going to talk about that more next time. I wanted to spend a little bit of time today, though, putting the wrap on UNH. Now, this is me changing course, and I realize that. So I'm going to make a public confession here. I've made an executive decision. We're going to take a different course on UNH. So here, if you haven't seen this trade in previous webcasts, if this is your first time here, this is a trade that we took back at the first part of January. That was all the way back here, a long call diagonal spread under the premise of what might happen if a trader just took a position and said, I'm sticking with this no matter what for an entire year. Now, the reason I'm changing course today is because I think the lesson has been taught, and I don't think I need to keep beating that same drum week after week after week for the remaining 4 months of 2025. So instead, we're just going to be wrapping this up. Dan says, wouldn't you look at extrinsic on NVIDIA? Dan, we'll talk about that next week. It's a good question. Today, I didn't want to spend too much time on the management of the current trades because I wanted to get to this discussion of trading the weekly strategies. But this one I did think we need to talk about this because I'm done with it. Yeah, the purpose here was to see if a trader just sticks with a strategy and they do their best, if it starts to go south, to try to salvage a trade. We've all heard this phrase, when somebody's trying to sell you a book on options, commonly they'll say, "Oh, I have this nifty approach called rolling. It just fixes everything." No, it doesn't. It might, but it might not. Rolling is not a fix. Rolling means that we get out of one trade and into another one on the same order ticket, and there's nothing more fancy about it than just there's nothing inherently magical about it beyond that. But commonly you hear, "Oh, if the trade's going poorly, we'll just roll it. We'll just roll it. We'll just roll it until it cooperates." Well, sometimes it doesn't cooperate. So here's what's happened with this one. We bought a long call, sold a short call against that. The stock started to collapse. This is a bullish strategy. So yeah, we've sold some short calls along the way, which have added up to some decent. Let me sort of expand this a little bit so you can see. So we made a profit here and a profit there and a profit there and a profit there and a profit there. So we add all that up and we made, I don't know, about $25 in realized gains on the short positions. But long position, we're down almost 100. So how did the rolling strategy work here? Didn't work. So you might say, "Well, Cameron, why don't we just keep rolling?" Well, we might. Here's the reality of the situation that this trader finds themselves in right now. This UNH long call was purchased for $102. It's worth less than $4. We haven't lost everything, but lost most. How do we get back to $102 of value? Well, very simple. We just need the stock to go all the way up here. That's our strike price. And then $102 beyond that in the next 500 days and change. Is that likely? No, it's not likely. It's almost certainly not going to happen. There's still some possibility. That's why this call still retains some value. But when we stick with a trade that is just failing and failing and failing and thinking that we can roll out of this, doesn't always work. And in my experience, this is just me speaking personally with having observed a lot of traders doing this over time, rolling unprofitable trades has led to some of the largest losses that I've ever personally witnessed. And here you get to see it. All right. So originally I was going to hold on to this, keep trading it all the way through the end of 2025. I don't think it's a lesson that needs to be taught every week between now and the end of 2025. So instead, we're just going to close this one up. But before we close it up, I wanted to make this final point. Why not just keep selling short positions against this long? Here's the problem with that. Let's say we wanted to sell a short, but we can't sell a short that's above our long strike. They're not worth anything. Or we'd have to go way out in time. We'd have to go out 300, 400 days to try to sell a short option that even brings in $1 or $2. So if we're selling something closer, let's say that we were looking at maybe selling a September 19th expiration. Well, we might have to sell something, let's say, for example, down here at maybe 280. All right, if we did that, let's go to September. Let's change our spread to just single so we can see all the individual strikes. And we look at maybe selling the 280 call. That might bring in about $2.50. Right? And again, that might help us a little bit as long as that expires worthless, which there's no guarantee that it's going to. That might, again, chip away at the damage that's been done by that long. But in the meantime, between now and September 19th, we would have the obligation, somebody has the right to buy shares from us for $280. And you might say, that's okay, this is a covered position. It is, technically. Because if someone bought the shares for us for $280, yes, we have the right to buy those same shares for $520. Probably wouldn't want to do that. So there is $140 of risk exposure between this short and that long. It's not exactly a naked call, but it's in that same neighborhood. So it would tie up a lot of money. It brings in a relatively modest credit against what is continues to be a losing position. Sometimes a trader might just want to throw in a towel. That's what I'm going to be doing today. Okay. Now, again, it's not the only thing that could be done. We could try to nurse this thing along, sell a short here, and as long as it starts going up, the short expires worthless. Nice. If it continues to climb, maybe we can dig ourselves out of this hole. RTR says not much to work with. Why not just close it? That's what I'm going to do, RTR, and that is a departure from what I said I was going to do. So I just want to state that again. Back when we first took this trade, I was going to trade this all year long, and I've just decided, nope, not going to do that. That point is made. Let's just right-click on this, and let's create a closing order to sell this call. Just be done with it. See if we can get, okay, it looks like maybe 355 up to 370. We'll see if we can get 355 for this long call. This thing is so far out of the money, it probably has a wide spread between the bid and the ask price. So that can make it even harder to get out of a trade when you're ready to be done with it. So that's another concern hanging on to something like this. In any case, let's click confirm and send. Going to sell that thing, take our lumps, pulling in, some value. It is $345 that we'd be leaving there to whittle away to nothing, most likely, if we just stuck with this trade. And let's send this order off. There is a commission to be paid as we're exiting here. And we'll see if that fills. I'm not confident that'll fill quickly because it's quite common for a wide spread between the bid price and the ask price. And with the mid and the natural 30 cents apart, we're probably looking at a 60-cent spread on the thing. All right, looks like we're out for 355. Okay, done with that one. That leaves us with the rest of our time today to discuss a new approach, not sticking with something for a whole year, but only sticking with something for a week. Let's go have a look at the S&P 500. See why a trader might take a position like this. S&P's had a great run since April, just making higher highs and higher lows. We've had a recent pullback. Really, this pullback consisted of basically 1 day of selling. There was a little bit. We hit an all-time high here, gapped down, but since then we've been in keeping with the previously established trend pretty much. So let's say that our trader is looking out just to plan a trade for the next week or so. They have to make an important decision, bullish or bearish. The trajectory of the markets for that week are very likely to play a big role in the ultimate performance of this trade. So there's point number one. When we're trading very short term, the trader needs to be pretty good at the timing of the markets over just a 1 week time frame. Now, even looking at a chart like this, even though it looks like we've had a gap down, maybe came down to, you've seen me illustrate this in previous webcasts. Looks like there was a previous price ceiling area that's been acting as more recently as a price floor. That might give the trader some confidence on a day-to-day basis. Looks like we're making higher highs and higher lows. Maybe they have some confidence that they can go out. Let's plan a trade for August 15th. Right now it's August 7th, so 8 calendar days, but only 6 trading days. Let's say that our trader just feels more confident than not that stocks have the momentum to go higher. All right. Josh says, if we stick with something for a week, I assume we're looking for positions with substantial liquidity, Josh. Yeah, I want to talk about the risks. This is, as with any approach to the markets, if there is no risk with a strategy, then there is no reward. I would love to find that strategy that offers a reward potential with no risk. You might think, oh, can't we just invest in something like a government-backed long-term bond? Doesn't that have no risk? Well, no, it still has risks. There's the risk of default, for example, but it's not very likely. It still exists in theory, though. There's the risk of inflation chipping away at any dollars made. That's a risk. In any case, any strategy that carries reward potential also has an associated risk. And so I want to make sure that we cover some of those for this. But let's just say that our trader is feeling pretty good about what they see on the chart. Maybe they envision, it might be helpful if we look at this on, let's switch up our time frame just for a moment. Let's switch this to an intraday view and just look at those last 5 days since we had that sell-off and we've started into recovery. Maybe look at this over an hourly view, and you can see that drop down. This might be significant. We've hit lows, rallied up to peaks, down to lows, up to peaks, down to lows. So we see maybe a short-term upward trend. And that may be a point of emphasis for our short-term trader looking at those, very short-term views, those perspectives. So let's set that as our technical backdrop from the charting perspective of the S&P 500, and now go plan and place a weekly options trade for a long call vertical spread using an individual stock. And Josh, you've already answered a big question here. What might be a pre-qualifier for a stock for a trader who's considering trading these short-term strategies? And liquidity is commonly a prominent, maybe among the primary considerations for setting up a strategy like this. What's the problem with trading options on illiquid stocks, especially when we're trading them short-term? Well, as we get closer to expiration, there's already going to be a natural drift between the bid price and the ask price. It just sort of happens. We're trying to minimize that as much as possible. The best way to fight, well, I don't know if I can say best. Best is a strong word, but one of the ways to fight against that is to make sure that we have a very liquid stock. So for some weekly spread traders, they may trade only the most liquid stocks out there. Maybe look at the S&P 500, stay with, who knows, top 5, top 10, top 20, something like that. Also, when we're trading multi-leg strategies, if there's an issue with liquidity, it's doubled. Or if we were to do more than one leg, it could be tripled or quadrupled. So that liquidity is a primary concern. Price per share is certainly a concern because we're getting close to expiration. Assignment risk is real. We may wind up with ownership of shares. I will say, on the point of assignment risk, I'm going to put that in air quotes because we're doing a long call vertical spread. Assignment's actually the objective of the trade. So let's go to an example stock here, and I picked out a couple. Let's look at a couple from a couple of different technical perspectives. First of all, we have Apple. Apple's a stock that's taken its lumps over the last 6 months, got into more of a sideways channel recovery phase. It appears to be. We got past this earnings announcement, but for some traders, what they may have been looking for is, well, first of all, have we finally reversed this downward trend? You'll notice as we draw a line across those peaks, it looks like today's activity has pushed us up through that downward trend. More recently, though, and this might be the time frame that our shorter term traders emphasize most, what's been happening most recently? And most recently, it looks like there's been a price level of resistance right here around 216-ish. And our trader might have been waiting for an event pushing us up through that. So yeah, in this case, we have a couple of potentially important price ceilings that have broken, and it's just happened today. So that could spur prices at least to hold above that level or maybe to higher levels. Of course, that's not a guarantee, but that precision of tactical timing on a chart is commonly an emphasis for our traders. Now, as tactical as we think we're being, when I use the word tactical, tactical sounds fancy. It sounds like a guarantee of performance. No, it's not. I wish that my favorite sports team, I'm a college football fan, I wish that our offensive coordinator's tactics always delivered a win. It doesn't. They still have tactics. They're still trying to be tactical, but sometimes they lose anyway. Anyhow, using an overview of what's happening with a major stock index could be important. Using a review of what's happening on the stock chart itself could certainly be important. So let's say that our trader's feeling pretty good about this. There was another one, though. This is from a different perspective. This is showing what's called a breakout entry. This, for ExxonMobil, might be for someone who prefers to trade near support levels. If we look at Exxon, you can see that this stock has really traded within two parallel ranges. Sometimes it trades in the upper range, sometimes it trades in the lower range. Overall, it's been going down, but a bullish trader still, even despite that downward trend, might say, well, we're very close to that support. I can make quick decisions if that support fails. But how this has behaved recently is we get down to that support and then risen off of that. And depending how I structure my vertical spread, might not even need it to go up. But for today, I think what we're going to do, let's use Apple as our example trade. All right, so let's talk about expiration selection. Well, we've almost answered that question. If we go to the trade tab and we start to plan a trade here for Apple, this discussion is for traders who are looking for trades that are in and out within 5 calendar days. That would typically incline the trader toward these first couple of expirations. There is an expiration for tomorrow, and a trader could conceivably set up a trade that expires tomorrow, or they may go out to the next week. Now, it's also possible that we could go way out here and just trade these for a week, but those would require a big move on the stock typically to produce any sort of sizable profit. Instead, how about we turn our attention to this expiration, 15th of August. This is not truly a weekly contract, which Josh, again, can address some liquidity issues. These monthly contracts that are displayed in black on Thinkorswim, they tend to have better liquidity, more liquidity than these purple weekly contracts. But they only come along once a month. So if a trader's trying to implement this strategy, they can just either wait and only do it once a month, or they might just have to get comfortable with trading the weeklies. Josh says, similar to UNH, are we staying with Apple for this weekly strategy? Yeah, we're going to be trading on Apple, but not beyond 1 week. Okay, so let's go to this 15th of August. And here's another thing that a trader needs to be prepared for. There are pros and cons to doing this sort of an approach. But when there's only a few days on a contract and we're trying to set up a vertical spread, there's typically not much profit to be had at all if we go very far in the money on the trade. So our trader may be trading right close to the at the money strikes. If we go even go $10 in the money, look at this. If we do a $2.50 widespread, the 207.5, 210, buy this one, sell that one, there's about $2.50 of distance between those two. So if it costs us $2.50 to enter into a $2.50 vertical spread, how much is left over for profit? There's nothing left there. So we're going to have to go closer to at the money. How about, with the stock at around 220 right now, let's say our trader is considering these two, not truly at the money, but the first two in the money strikes. What might we be able to get out of that? Looks like there's somewhere around $1.70 difference between those two. If there's $1.70 difference between the two strikes on a $2.50 vertical spread, how much does that leave for reward? About 70 cents. Now that's not nothing. That's actually a pretty strong potential reward. I think we're going to be using that as our example trade today. So we're already starting to tackle, okay, we need to be aware of how the trade might be set up. We need to be aware of some of the potential risks or concerns. Liquidity is a big risk. Might have to trade closer to at the money, which means that the stock doesn't have to move very far for this to reverse its way out of the money and put us in a maximum loss scenario. But let's do that one. How about we map that out as our example trade? Let's open up our scratch pad here. Our example trade is going weekly. I don't even want to rephrase this since we aren't truly using weeklies. How about we call this a sub 5-day long call vertical or long call spread. That's our strategy. Let's open up this left column a little bit more so we can fit this all in there. And here's what ours is going to look like. We're going to buy quite close to at the money, buying, let's say, the 15th of August, 215 call. And that looks like it's trading up around 655. We don't know unless and until the order fills. But at the same time, we're going to sell the 15th of August, 217 and a half call. And that looks like that might bring in between 485 and 495. We'll call it 490. There we go. So what's the reward potential of this trade? Well, there's a $1.65 difference between the two. If we spend $6.55 to buy this one and we receive $4.90 for selling that one, that gives us a net cost. That's a net debit. Also, our theoretical maximum loss is $1.65, leaving us as a theoretical maximum gain. If we spend $1.06, here's the reality of this trade. We're entering into two contracts. One gives us the right to buy shares for $2.15. Another one obligates us to maybe sell those shares for $2.17 and a half. That would be a $2.50 reward, except it cost us $1.65 to set this up. So that leaves us with about 85 cents. Somebody call me out on the math if I messed anything up. That's a possibility. But we're basically tying up $1.65 in pursuit of 85 cents, or $165 in pursuit of $85 in 8 days, 8 calendar days, 6 trading days. I'm going to be planning to be out of this by next Thursday at the latest, so 5 trading days at the most. That means we're probably not going to make the full 85 cents. We're going to have to be prepared to make less than that, and that's going to be one of the ways that a trader might plan to manage this. But in any case, that's about a 50% return in 1 week. Oh, wow, that sounds amazing. Well, let's be realistic about this. We need to be aware of the pros and the cons of our strategy. So to help us and visualize this, let's draw a few lines on our chart. So this is our expiration right there. It is tantalizingly close. It's right around the corner. But in the meantime, we are selling this strike. Let's draw that in. And we are buying right down here, just a shade below that broken resistance area. That is our spread. So how much movement would it take for this trade to go south on us? If this is our maximum loss zone, right down here, let's edit those properties. Let's make this one sort of an intimidating pink. This is where we do not want to go. We prefer to be up here as we move toward that expiration. Anywhere up there. Could be up here further. I just draw those in representative. Probability trader says, I still think it's not fair to focus showing every tool, learning only focusing on bullish should be equally important to learn. No doubt, probability trader. Yes. Yep. Yeah. Every once in a while, I sprinkle in a bearish discussion. The reason I place these this way is because for my audience, it seems it's probably more intuitive to be trading bullishly when the markets are bullish. But yeah, to provide a truly balanced education, we need to show both sides, both directions. Fortunately, we have. So even though the live webcasts, a lot of them might be focusing on bullish strategies, we have a vast library of webcasts where we have previously discussed bearish strategies. So yeah, remember guys, and I know probability traders are already aware of this, but just for everybody, if you haven't subscribed to our Trader Talks channel just yet, make sure that you do. Go down in the lower right-hand corner, click on that subscribe button. It only takes a second. doesn't cost anything. But our Trader Talks channel is where we house those. Let me just hit the refresh button here. But this is where we house our playlists of previous webcasts, including all sorts of discussions on bearish strategies. So we don't have to wait around for one of our presenters to get to a bearish approach if that's our emphasis, like maybe I want to learn about bear call spreads. So here we can just find bearish strategies. We can just scroll down through until we find one that looks appealing to us, right? But let's get back to today's trade. I just want to point this out, that as appealing as it might sound to be looking at the potential of a 50% return, well, as long as we're above our strikes and as we move our way toward expiration, we're in good position to be making those returns. But it doesn't take much when trading these short-term positions for a stock to reverse down into maximum loss territory. As a matter of fact, if we got to move in the wrong direction equal to today's size, we could be in max loss, not at max loss, but in max loss territory by tomorrow. If we got a move equal to the previous day's move, yeah, this is not necessarily a strategy for the faint of heart. But it's also a strategy where the trader might need to pay a lot of attention to what's going on from day to day. So here we go. What are some of the issues with this sort of approach? Because it's fun to talk about 50% reward potential, but also the risk. Liquidity is a concern. Trading closer to at the money is a concern. I do want to talk about assignment risk, though, because assignment is commonly stated as though it's always a bad thing. It's not always a bad thing. What would happen if our short call buyer, person we sold our short call to, what if they decided to say, hey, Cameron, I want your stock. I'm going to pay you $217 for it right now. I'm assigning this contract. What that would do is it would just immediately produce maximum gain. What we could do at that moment is react by exercising our right to buy the shares. Matter of fact, if they did that before expiration, it may be possible to make even a little bit more than the 85 cents, depending on how we handled the exit. But most directly, if someone buys the shares from us for $217.5, we buy those for $215. That's a $2.50 gain minus the cost of the trade, leaving us with our maximum theoretical reward. That's why I put this assignment risk in air quotes. Sometimes assignment is the best objective for the trade. All right, but let's talk about managing the risk and the reward potential of this trade, and then wrap our trade up. Let's talk about the fun part first. If this trade is going well, it could produce profits very quickly because we're very close to expiration. The gains or losses tend to manifest themselves quite quickly. So we may have to wait till next Thursday to see a significant gain, but it could be tomorrow. If we get another big move up, it might be, hey, we're halfway to our maximum gain that quickly. Even just sliding sideways for a few days could produce, let's say, as much as half of the maximum gain quickly. So let's say that if our trader is positioned here to make 85 cents, let's say they'd be willing to just take their profits if they could make half of that and be done and not have to deal with this continued market risk. By the way, let me do a quick question. What do we call it? What do we call this fact that if we're in a trade, in an option trade that's really close to expiration, if the stock goes the wrong direction, we don't have much time for that to recover? There's a name for that. It's a fancy name. What does it mean? What's that name? It's called gamma risk. If you're not familiar with gamma risk, it's a fancy way of saying if the stock misbehaves, there's not much time for the stock to get back on course, right? I won't go deeper into exactly what gamma risk is, but if you've ever heard that phrase, that's basically what they're describing. So let's say that our trader here maybe they just want a quicker profit, smaller, but quicker. If they're able to get out with, let's say, half of their planned gain, maybe they get out. So we're going to do that for today's example. But there's also the possibility the trade might fail. We might drop. So maybe with the way that we've structured this, if we even get down below that support level, which is just going to be right down to our lower strike, that's down there at 215. Maybe the trader has a plan to pull the plug, not waiting till expiration where we'd be at maximum loss, but pulling the plug and trying to get out with less than maximum loss. So we can set a stop based on a stock price. In this case, breaking below 216 and getting down there to that 215, that has us in the wrong spot. Let's plan on getting out at that point if the price happens to fall below 215. So let's go place our trade with those two exits. Here's a quick way to place a trade on Thinkorswim. We can change our spread from single to vertical. That pairs up our strikes with each other. So then to make our purchase, we just need to come to the ask price for the intended strike pair and click on it. So let's click on the 215, 217 and a half, click on that ask price, and that creates a buy order. Now we calculate, $1.65. Let's say we're willing to spend up to, who knows, 160. Let's say 170, leaving 80 cents for profit. Okay. So let's set that as our limit. Well, if our plan is to get out with half of that maximum gain, 80 cents could be gained. How much would we need to sell this for a 40-cent profit? Oh, we'd need to sell for 210. If we buy at 170, sell for 210, that would be a 40% gain. So I'm going to come down here where it says single order. I'm going to change this to first triggers OCO. So if our first order fills, it's going to trigger a one cancels other order for two potential exits. Pardon me. But let's see, this would be $170 of risk. Let's do 10 of these. That would be $1,700 of risk. And then let's right click and create an opposite order. This order is going to be a limit at 210. That's to get us out with a 50% maximum gain profit. We'll make that good till canceled. And we're going to right click again, create another opposite order. This one is to exit at our stop. So I'm going to go over here to the gear, and we're going to sell out of this at a future market price if Apple market value falls below, what did we say, 215, right? If you've never used this condition before, we're setting up a condition. If the market value of Apple falls to less than or equal to $215, that will trigger a sell order, a market order to get out of this trade. Save that. And let's click confirm and send. Buying these 10 verticals for 170, selling them for 210 if we can make a profit, or exiting if the stock happens to fall down to below 215 at any point. Let's send that order off. Okay, we'll see if that fills. That's working. 170 is what we're offering to pay. Filled. All right, 165. Hey, that's actually the original planned purchase price. As we have accomplished what I set out to do today, I wanted to talk through current positions, look at the markets, and then talk about the pros and cons of trading weekly trades on a long call vertical spread, looking at how the trade might work, how it might fail, and we planned and placed that trade. This is what we do on these Thursday webcasts. I hope you enjoyed that discussion. I hope you'll put it in your calendar to join us each Thursday as we follow along with these trades. But we also have other webcasts outside of this one. So make sure that you've subscribed to our Trader Talks channel. If you haven't done that, you can just go down in the lower right-hand corner, click on the subscribe button. It only takes a second, doesn't cost anything. But our Trader Talks channel is where you can find the playlist for these webcast series. You can join the live streams, or you can even do keyword searches. Also, make sure that you're following Brent and me on X. It's the best place to connect with us in between these live streams. You can find Brent on X and give him a follow at Brent Moores CS. You can find me on X, give me a follow at Cameron May CS. Sometimes on X, you can even see my display of artistic talent. Did you see this? Look at that. That roller coaster ride we've been on for the last few days. Anyway, yeah, if you reply to one of my posts on X, I try to reply right back to you. Best place to connect with me in between the live streams. But everybody, thanks for giving me your time today. Thank you to everybody who's clicked the thumbs up. I see over 200 people watching and 62 have already clicked the like button. That's definitely appreciated. It's a pat on the back to your presenter. It gives their webcast a boost in the YouTube algorithm. So helps more people find these webcasts. Hey, thanks, guys. I will look for you in a future webcast. I'll also look for you on X. Brent, thanks for helping out in chats. There is a survey, so everybody, if you can now click on that survey link, go fill out that survey for me. I'll read those survey comments. I read through that data. It always helps. All right. I'll see you in a future webcast. I'll see you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.